Both losses belong to the same actor. 100,000 euros. Two responsible choices. The actor took one. Both choices ended below the start. The subject is the choice the actor did not know was being made. This episode does three things. It examines the choice and the cost of each path, and a third frame, neither choice provides alone. By the close, the question becomes how much path the actor commits to one decision. The actor stands at the decision point. The capital is 100,000 euros. Two actions are possible. The first action is to deploy the capital now. The second action is to hold the capital and deploy later. The first action exposes the capital to market risk. The second action exposes the capital to time risk and inflation. Each action is a path through wealth space. The actor will live exactly one path, not the average of both. Path A. The actor deploys the full capital today. The capital enters a risky asset. The return distribution governs what follows. Within 18 months, the path enters a deep drawdown. The drawdown is not unusual. It is the third decile of historical paths over this horizon. The position is now at a loss. The actor does not yet know whether the loss is temporary or permanent. An exogenous shock reaches the actor. The shock requires capital. The capital must be liquidated at the current drawdown. The realized loss forces liquidation at 18 months. Retirement shifts forward 8 years. The decision to deploy was rational. The outcome is path-specific. The chart that follows is the most quoted chart in finance, and the most blind. This is the 100-year compounding curve. A unit of capital invested in the market index in 1925 reaches roughly 2,500 units today. The curve is verified across 100 years of market data. The conclusion that emerges is that time in market beats timing the market. This is the naive frame the audience is most likely to hold before this episode. The chart is correct and incomplete. It omits one fact. The chart shows the survivors. It does not show the paths that absorbed below the recovery threshold and never returned within the horizon. Those paths exist. The actor cannot know in advance whether the path lived is one of them. The band now expanding marks that recovery threshold. Path B. The actor holds the capital in cash. The capital is not lost. 8 years pass. Inflation reduces the real purchasing power each year. Markets compound away from the saver during the same period. Retirement arrives with nominal capital intact and real capital reduced by a third. The safer-feeling path destroys purchasing power more reliably. The actor returns to the decision point. The two outcomes just shown are not predictions. They are the failure modes of each pure choice. The next step examines the model the naive frame supports, the model that quietly recommends immediate deployment. Risky assets carry an expected return above the risk-free rate. The expected return is positive on average. Over a long horizon, the average reaches a clear positive value. The compounding curve emerges from this average. This is the equity premium argument. The curve hides its substrate. At each year, the return is a full distribution, not a single number. The compounding curve traces through the mean of each distribution. The investor's actual path is sampled from those distributions, 1 year at a time. The mean is one possible result. The actor lives one sample. The argument so far has a hidden assumption. The assumption is that averaging across distributions is the correct way to describe the path lived. The next minute examines this assumption directly. The distribution now stretching has a longer tail than the average suggests. The tail is where the path can land. Expected value collapses a distribution into a single number. The collapse happens now. At year 5, the distribution's area becomes a single point on the compounding curve. This point is the model's prediction for year 5. The same operation runs for every year. The compounding curve grows through these implied collapses. At year 30, the operation runs again. The distribution contracts, the value lands on the curve. The compounding curve is the chain of these outputs. The model has just been built. Two averages exist on a return series: arithmetic and geometric. The arithmetic mean produces the curve seen so far. The geometric mean produces a second curve. The two curves leave the same origin and diverge. The geometric mean is what the capital actually multiplies by over time. The gap between them is variance drag. The model is true and incomplete. It cannot predict unrecoverable paths. The same actor returns to the same decision point. The previous chapter showed the model in its naive form, a smooth curve through the mean of each annual distribution. The next chapter shows what the model actually generates, not the curve through the average, but the full range of paths the model permits. Each path is a sample from the same return distribution. The first sample is here, the second, the third. The model permits any of these paths. Each path is internally consistent with the model. The compounding curve from Chapter 2 is the average of paths generated this way. Many paths must exist for that average to be defined. The actor is one of these paths, marked. The other paths exist in the model. The investor does not live them. They are alternative realizations. Only one will be traced. The actor cannot know in advance which one. The actor's path begins to descend. Other paths in the ensemble continue upward. This path is not unusual. It is a sample from the same distribution. The horizontal barrier visible here is the absorbing level. A path that crosses this level cannot recover within the investor's horizon. Some paths cross, others do not. The actor cannot know which kind in advance. The mean of all paths is traced now. The mean is a clean line, the curve from Chapter 2. The mean averages across past paths: 2000, 2008, March 2020, 2022. The actor will not live these paths. The mean averages over all of these and many more. The mean averages over paths the actor will never live. The expected return is the average across all of these. The actor lives exactly one path, this one, which crosses the barrier. The actor does not benefit from the average. Path-dependent risk dominates expected value. The model that produced the chart in Chapter 2 is correct on average. The model is also incorrect for any actor who lives a path that absorbs. A second frame survives both problems. The frame arrives next. The actor returns to the decision point. The barrier from the previous chapter remains visible behind. The question replays: not invest or wait. The choice the decision maker faces under the constraint that one path will be lived. Now the frame shifts to cash. The naive view of cash is the straight line now being drawn. Cash returns zero in real terms. Cash provides no compounding. The naive view treats cash as zero yield. The naive view is wrong. The line bends. Cash carries optionality: fall, deploy cheaper, rise, hold, or partial. The cash payoff is a convex curve, not a line. The space between the line and the curve is what the naive view misses. The region grows with volatility and horizon. This is what cash actually returns. Cash is not zero yield. Cash is a derivative on future information. The expanding region is the option value of holding cash through uncertain conditions. The next minute prices this option for the investor's situation. The investor does not have to commit the full capital to one path. The bag splits. One half deploys to the risky asset. The other half remains as the option to deploy under future information. This is not a compromise. This is a different structural choice. The structure now contains exposure to upside and retained capacity for response. The investor accepts some pathwise risk and retains some optionality. The barbell structure bounds downside risk, preserves upside, and retains optionality in one allocation. The landscape now built is the model's full prediction. Horizontal axis, fraction of capital deployed at decision time. Vertical axis, probability that the path absorbs below the recovery threshold. The contour lines connect equal risk allocations. The actor's position, partial deployment, partial retention. Cash is not a return of zero. Cash is the highest yielding asset the actor can hold under one condition. The condition is that the actor's path must survive. The final chapter names the survival rule and shows what the math can and cannot decide. The actor returns to the decision point with both bags. The optionality landscape from the previous chapter remains visible behind. The question replays under a third frame. Not invest or wait. How much path the actor is willing to commit to one decision. A boundary is now drawn on the landscape. The boundary separates allocations that preserve survival from allocations that do not. Inside the boundary, the path lived remains within recoverable range across the realizable distribution. Outside, some realizations terminate. The decision rule has two steps. First, identify the survival boundary. Second, select the allocation inside it that preserves upside. The math does not produce a single number, it produces a bounded zone. The decision lives inside the zone. Three allocations are now traced: pure deploy, pure wait, barbell. Pure deploy starts outside the survival region. Its expected return is highest, but realizable paths cross the absorbing barrier. Pure wait starts outside in a different direction. Its expected return is lowest, and inflation moves it further from survival each year. Barbell starts inside. The math has just produced the shape of each cost. The math can do this. It can identify the survival region. It can shape each allocation's cost. It can show that the barbell preserves the investor's optionality. The math cannot select inside the region for any given actor. The next minute names the limits. The boundary is now fraying. The boundary frays at 3 points. First, model assumptions. The return distribution the investor cannot verify. Second, stress test assumptions. Future stress drawn from past distributions, unverifiable from inside the model. Third, deep uncertainty. Futures that exist in no distribution. The math has no statement about them. The boundary does not close. The question invest or wait has no answer. The question how much path the actor commits to one decision has an answer. The answer is bounded, not a point, and the math just shown is how it is approached. The decision belongs to the actor. The math has shown what each choice actually costs.